Okay, so you want to buy a toll road. Pave a stretch of asphalt, put up a few digital gantries, sit back, and charge every single commuter $4 just to go to work and back. Sounds like the ultimate passive income machine, right? It's literally a legal monopoly. You own the only fast pipe between point A and point B, and drivers have no choice but to pay up or sit in soul-crushing traffic. But here's the strange part. Toll roads are one of the most expensive, politically explosive, and mathematically brutal businesses on Earth. They require billions of dollars up front, they rely on decades of debt, and a single bad traffic projection can send a private infrastructure titan straight into bankruptcy. Anyway, by the end of this video, you'll know exactly how private companies buy roads from governments, how the money actually flows through the gantries, the hidden costs that eat away at those massive toll payments, and why a toll road isn't really a transportation business at all, it's a massive hedge fund dressed up as asphalt. To understand how you even get into this game, you have to look at how these deals are structured. Governments are almost always broke, but they need new highways. So they turn to private consortia consisting of private equity firms, pension funds, and massive construction groups, and offer them a deal called a public-private partnership, or P3. In a typical concession agreement, the government hands you the rights to build, operate, and collect tolls on a highway for anywhere from 30 to 99 years. You fund the construction and maintenance, and in return, you get to keep the revenue. Now, let's talk about what it actually costs to build one of these things, because the numbers are staggering. Building a modern, high-capacity toll road isn't just laying down gravel and pouring concrete. You're looking at an average cost of $5 million to $15 million per lane mile in open rural areas. But if you're building an urban express lane network that requires land acquisition, bridge retrofits, and complex interchange designs, that figure can easily skyrocket to $50 million or even $100 million per lane mile. Look at the Central 70 project in Denver, a 10-mile stretch that cost roughly $1.2 billion to overhaul. And before you even pour a single drop of asphalt, you're spending tens of millions on environmental impact studies, legal battles over eminent domain to acquire private land, and complex utility relocations. Moving a high-voltage power line or a major fiber optic trunk out of a highway path can cost upwards of $10 million on its own. So where does the money come from? You certainly don't buy a toll road with cash sitting in a bank account. A typical toll road project is financed with a hyper-leveraged capital structure. We're talking 70% to 80% debt, and only 20% to 30% equity. That means if a project costs $2 billion, you're borrowing around $1.5 billion through senior secured project bonds and bank loans, while putting up only $500 million of your own investors' cash. The entire financial engine relies on the assumption that steady, predictable traffic will pay off that massive mountain of debt over the next 3 decades. So, how does the money actually flow in? Modern toll roads don't use cash booths anymore. Those human collectors and physical barriers are a thing of the past because stopping cars destroys highway throughput. Today, it's all about all-electronic tolling, or AET. Overheads feature high-speed cameras and RFID gantries that read transponders at 70 miles per hour. This brings us to the revenue model, which is surprisingly dynamic. Some toll roads use flat rates, but the real money is made using dynamic congestion pricing. Here's how it works. Algorithms monitor real-time traffic density and speed every 2 to 5 minutes. As traffic builds up, the toll automatically ticks upward from $1.50 to $4, all the way up to $15 or more during peak rush hour. The primary goal of dynamic pricing isn't just to extract maximum cash from drivers. It's to price out just enough demand so the express lanes maintain a guaranteed minimum speed, usually around 45 to 55 miles per hour. You're not selling pavement, you are selling time. On paper, the revenue looks incredible. Take the Indiana Toll Road, a 157-mile stretch that was leased to a private consortium in 2006 for a eye-watering $3.8 billion upfront payment. In a typical healthy year, a major toll corridor can generate anywhere from $100 million to over $500 million in gross toll revenue. But here's where the math gets brutal. Where does all that money actually go? First, you have operational expenditure, or OPEX, which is surprisingly light compared to other industries. Because the system is automated, operating costs usually hover around 15% to 20% of gross revenue. This covers things like electronic tolling software, processing fees, transponder networks like EasyPass take a small cut of every transaction, along with license plate recognition, billing systems, customer service centers, line repainting, winter snow removal, and routine incident management units. Then comes capital expenditure, or capital expenditure, which is the slow, silent killer of road profitability. Asphalt doesn't last forever. Every 7 to 10 years, a heavy traffic highway requires a major overlay, shaving off the top layer of degraded asphalt and repaving it. Every 20 to 30 years, you're looking at full-depth reconstruction. Furthermore, bridge decks degrade, expansion joints fail, and drainage systems clog. A private toll operator has to set aside a massive reserve fund, usually 10% to 15% of annual revenue, strictly for long-term rehabilitation. If you skimp on maintenance, your concession contract usually includes heavy financial penalties from the state. So after OPEX and capital expenditure, you might be looking at an EBITDA margin that's earnings before interest, taxes, depreciation, and amortization of roughly 70% to 80%. That sounds absurdly lucrative. An 80% operating margin? That's better than Apple or Microsoft. But remember that massive pile of debt we used to build or lease the road in the first place? That's where the illusion shatters. Debt service paying back the principal and interest on those billions in project bonds consumes the vast majority of that operating profit. In the early years of a toll road's life, debt service can eat up 50% to 70% of total revenue. Think of a toll road like a massive residential mortgage on a house, but with one crucial difference. If your tenants in this case, drivers don't show up in the exact numbers your spreadsheets predicted, you can't pay the mortgage. And this brings us to why these seemingly guaranteed legal monopolies fail so spectacularly. Traffic forecasting is an art disguised as a science. Investment bankers and traffic engineers build complex spatial models called traffic and revenue studies to predict how many cars will use a road 20 years into the future. But these models are notoriously prone to optimism bias. Look at the Pocahontas Parkway in Virginia, or the Southern Connector in South Carolina. Both were built with private financing, based on aggressive growth projections. Engineers assumed massive suburban developments would pop up along the routes, driving hundreds of thousands of commuters onto the toll lanes. But when the housing market slowed or drivers simply chose to take the slower, free back roads to save $4, traffic came in at 40% to 50% below projections. Because the debt payments are fixed, but the revenue is variable, even a 15% drop in expected traffic can instantly wipe out all net profits and push the operating company into technical default. That's precisely what happened to the Indiana Toll Road Concession Company, which filed for Chapter 11 bankruptcy in 2014 under a staggering $6 billion debt load. The traffic simply didn't match the aggressive, debt-fueled projections made right before the 2008 financial crisis. And let's not forget the wild cards, black swan events and politics. When COVID-19 hit, commuter traffic plummeted by over 70% almost overnight. While standard businesses can downsize staff or pivot products, a toll road operator still has to pay the fixed interest on a $2 billion bond issue, even if nobody is driving on the highway. Politically, if inflation spikes and you try to raise tolls by 8% as allowed in your contract, public outrage can force local governments to stall your rate hikes or tie you up in court for years. So, Why do smart institutional investors, like Canadian pension funds, and Australian infrastructure giants, like Transurban, keep buying them? Because when the math works, the payoff scenario is unlike almost anything else in the financial world. Once a toll road passes its inflection point, usually around year 10 to 15, the debt is steadily paid down, traffic volume stabilizes, and toll rates compound with inflation. At that point, the leverage flips from a massive risk into a cash generation machine. Margins on free cash flow can skyrocket, turning a boring stretch of gray concrete into an inflation-hedged dividend factory that prints high-yield cash for decades. At the end of the day, owning a toll road isn't about loving infrastructure or moving cars. It's an ultra-complex game of interest rate arbitrage, traffic modeling, and long-term risk management. You aren't just managing a highway, you're managing a decades-long financial derivative laid out over miles of asphalt.